Hey everyone, hope you're all safe and well. My name is Arjun and welcome back to another video. Nobody enjoys paying taxes, right? You look at your salary and you start dreaming big. You think, I'm gonna buy a nice house, travel the world, eat the most amazing food. But then when you look at the amount that actually hits your bank account, you realize that the IRS has taken 30% away. So today we're going to be talking about the ultimate tax loophole, HSAs or health savings accounts, and whether it makes sense for you to get one or not. Right now is the best time to be thinking about this because most companies have annual benefit enrollment going on, which is your once in a year chance to make changes to your benefit plan. So understanding this right now puts you in a very strong financial position for next year. This video is packed with information all the way through, so I encourage you to watch to the end because I'll be sharing the exact spreadsheet I used to find the best healthcare plan available. And trust me, you do not want to miss out on that. Let's start with the basics though. What exactly is an HSA? As the name suggests, it's a savings account intended for healthcare expenses, but it has a host of amazing tax benefits. These health savings accounts offer what's called a triple tax benefit. Contributions to this account are tax deductible, money grows in this account tax free, and as long as you use it for qualified medical expenses, the withdrawals are tax-free as well. These benefits are so good that they can't be matched by any other account, not even the 401k or the IRA. And I've made videos on both of these which I'll be linking to up here. Many people get confused by this. An HSA itself is not health insurance. It's just an add-on to an actual health plan. In order to be eligible, you need to have what's called a High Deductible Health Plan or an HDHP. For those of you who are unfamiliar, a deductible is what you have to pay out of pocket before the insurance company steps in. If you open up an HSA and contribute to it, your money carries over from year to year, and you have the added benefit of being able to invest within it as well. What I really like about HSAs is that nowadays, many employers contribute to it as well. This usually involves doing some small activity like filling an online survey or taking a physical. But hey, it's still free money, right? These employer contributions can range anywhere between a couple of $100 all the way up to maybe even $1,000 per year in some cases. There are of course limits to how much you can contribute to this account. And for 2021, that's $3,600 if you have single person's coverage and $7,200 if you have family coverage. One thing to remember here is that these contribution limits are for both employee plus employer contributions, and that's different from the 401k, so just keep that in mind. You might have also heard about another similar sounding account called an FSA, and that's a flexible spending account. That is different from an HSA because of 4 reasons. 1. You do not need to have a high deductible health plan, and all employees can contribute if it's offered to them. 2. The contribution limits are lower at $2,750 for 2021. 3. Money in an FSA cannot be invested, so it does not grow. And most importantly, 4. This is a use it or lose it type of account. So this means that any unused funds does not roll over to the next year. From what I've seen, unless you're someone who visits the doctor regularly, an HSA is better than an FSA in most cases. If you do have some sort of medical expense, let's talk about how you can use your HSA to fund that. First, I'll tell you what most people do, and then I'll tell you about a better way to do things. So let's take an example. Let's say you're playing soccer and somebody slide tackles you from behind, just like properly cleans you out. You realize you've broken your leg, so now you obviously have to go to the hospital. You get treated for your broken leg and the bill comes out to be $1,000. Most people pay for this using an HSA debit card, which you get in the mail shortly after opening your HSA account, or they get the bill and immediately pull funds out from their HSA. But here's a smarter way to do things. If you can afford it, do not withdraw any money from your HSA account and pay for it in full out of pocket. I use my credit card so that I can rack up a few points and cash back through this. One of the biggest advantages of an HSA is that you can invest your money. And I'll be talking more about that later on in this video, but just stay with me for now. Leave your money in your HSA, invest it and let it grow. At the same time, save all of your medical bills. Since you didn't withdraw from your HSA, that same $1,000 that you would have taken out is now allowed to compound and grow over the years, completely tax-free. As long as you have proof in the form of your medical bills, you can reimburse yourself for this $1,000 at any point in the future. Obviously, if you're doing this, it's extremely important to keep a solid record of your medical bills. I have this folder where I keep track of all of my medical bills. If I open it up, you can see that, these are all of my medical bills over the years, and I make sure that I keep it extremely safely. Obviously, there's a risk of losing it, so I've scanned all of my receipts onto the cloud just so that it's in multiple places. Again, your HSA account comes with a high deductible, so only employ this strategy if you know you can afford your bills out of pocket. Now you might be thinking to yourself, Arjun, all this is well and good, but does it actually make sense for me to get one? I'll give you my straightforward answer first. If you're someone who's young, healthy, doesn't go to the doctor's office often or take a lot of prescriptions, then a high deductible health plan with an HSA is a good choice. On the flip side, if you're someone who takes frequent trips to the hospital, has the rest of your family, including your kids on your plan, as well as other ongoing healthcare costs, then a more traditional healthcare plan like an HMO or a PPO would suit you better. So there, if you came for a two-line answer, there you have it. But as many of you probably know by now, I'm someone who loves numbers and calculations and coming up with accurate estimates. So I'm going to share with you the exact spreadsheet I used to find the best plan for me. Okay, so I put a link to this file in the description box, and if you click on it, it should take you to this Google spreadsheet. Quick shout out to this Redditor called HSA Spreadsheet Guy. He was the one who created the base version of this. I built on top of that and created this easy to use version for all of you, including instructions, the glossary of all of the terms. All of this is completely free for you all. So if you want to show your support for what I do, please like this video and subscribe to my channel if you haven't already. I really appreciate it. Okay, so moving back to the spreadsheet, what it tries to do is compare two different health plans based on your annual healthcare expenses, and it calculates which plan is more cost effective between the two. So the first thing I want you to do is to come to this tab that says read this first. I have instructions here, so click on file and make a copy of this first because it would be read only otherwise. I also have a glossary of terms here that explain each of the factors that go in, as well as some of the limitations. Come over to this input tab, and this is where you input information that powers the graph in the first tab. Let's go ahead and put in some example numbers and see what happens. So let's start with this low deductible health plan. Your premium is the amount that you pay on a monthly basis. And for this low deductible health plan, let's say it's $200. Your deductible, as I said, is the amount you have to pay out of pocket before the insurance kicks in. Let's say in this case, this is $400. The co-insurance is the amount you owe after your deductible has been met. So let's just leave this at 10% for now. And your out-of-pocket max is the maximum amount you can pay for your healthcare in any given year. Let's just say for this plan, it is $4,000. And let's go ahead and do the same thing for the high deductible health plan. Let's say the premium is $100. The deductible is $2,000. The co-insurance, we'll just leave it at 20%. And the out-of-pocket maximum, we can put it at $6,000. So once you've done this, you move over to the taxes. Your federal tax rate would be your marginal tax rate. So let's just say that's at 24%. State tax, I live in Texas, so I'm just going to put 0%. And your FICA tax rate is the taxes for Social Security and Medicare. For most people, it's 7.65%, so I'm just going to leave it at that. So this spreadsheet also accounts for FSAs, but for simplicity's sake, I'm just going to skip that for now and just move over to the HSA contribution. Let's say your employer contributes $500 and you contribute $2,000 to this HSA. So now that's all of the input that goes in, and this, goes and feeds into this page, which is the calculations page. It would take another 15-20 minutes for me to explain everything that's going on here. So for this video, I'm just going to skip that. But let's move over to the comparison graph. So this page basically tells you which plan amongst the two is better. So if you look at this graph right here, the lower on the y-axis, the better, because this is the effective cost. So basically what this graph is telling me is that up until $2,000, $4,000, $6,000, $7,000 a year in healthcare expenses, the HSA plan with the HDHP is more cost effective. And if your medical expenses exceeds that for the year, then you're better off going with the low deductible health plan. In terms of how much to contribute, you can play around with some of these values, but a good general goal is to contribute at least enough to meet your deductible every year. So click on the link, put in numbers based on your own plan, see how the graph looks, and decide which plan is better. The downsides to opening an HSA are that the deductibles are quite high, usually $2,000-$3,000 or more, and that means you have to pay out of pocket until you reach that deductible amount. So you have to be able to stomach these large amounts if you're opening an HSA. For visa holders who plan to stay only for 1 or 2 years, it's probably not worth the hassle to manage another account that you can't touch until you're 65. So I would stay away from it for people who are only here for that long. If you do decide to get an HSA, as I mentioned earlier, you have the ability to invest within it as well. Your provider might have many options to choose from, like stocks and mutual funds and ETFs. But since this is a more long-term investment, I like to keep things fairly simple and just invest in an S&P 500 index fund. Some providers only let you invest once you've crossed a certain threshold of dollars in your account, and that threshold is usually around $1,000 or so. My strategy for how much I invest within my HSA is this. I keep the amount equal to my deductible in cash and just invest anything over and above that. If you want to employ a more conservative strategy, you can choose to keep maybe up to the out-of-pocket maximum in cash and then invest anything above that. Okay, so let's say you've been living in the US for a while, but you realize that you miss your family back home, maybe you want your kids to grow up in a different country, and you've just had enough of these chai tea lattes and crave for the original. Don't worry, I got you covered. Here are your options for your HSA if you decide to leave the country. Option 1 is to cash out the entire amount before you leave. This comes with a 20% penalty as well as paying income tax on the amount, so this might not be the best option. Your other option is to leave your HSA in the US. You won't be able to contribute to it, but the money does stay invested. In my opinion, I think this would be the preferred option, because you can use your HSA funds for qualified medical expenses even abroad. Just keep in mind that any year you pull money out of your HSA, you'll have to file a Form 1040NR as well as a Form 8889. The HSA is one of my favorite saving and investing accounts, but sadly not too many people take advantage of it. So if you ran the numbers and found that this plan works for you, call up your HR right away and ask how you can set one up. If you all have any questions on the spreadsheet or just HSAs in general, let me know in the comment section down below. I try to answer every single comment or DM that I get on Instagram, so don't be shy, ask away. If you're interested in more content like this, make sure to check out the other videos on my channel. They're all about personal finance, saving money, and investing. Feel free to share with your friends too if you think that they'll find it useful. With that said, I think it's time for me to go take a nice evening stroll. It's a beautiful day out here in Austin. Thanks again so much for watching to the end of the video. I'll see you next time.